economy has gone from being on the mend to on the move. But I know the families all across America are hurting because of inflation.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. If we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, we might be predicting, then we can adjust.
I would reverse the perma ban. Obviously, I don't own Twitter yet, so this is not like a thing that will definitely happen, because what if I don't own Twitter?
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Cleveland Fed President Loretta Mester says the FOMC may need to hike by 75 basis points if inflation does not subside. US CPI is out today. Chinese stocks jump as coronavirus cases drop, but a study warns Beijing risks a tsunami of infections if it abandons COVID-0. Plus, European gas supplies are threatened after Ukraine says Russian pipeline throws through the nation could be disrupted. OK, let's check in on these markets. The gains we're seeing slightly modest here in the session, not quite as bullish as the optimism had suggested in the lead up, with the futures pointing to more solid gains that have actually materialised. But still, across the European stocks and the benchmark, you're seeing gains of 0.4%. Of course, we are looking to that CPI print, and our team, the MLive team and Mark Cudmore, have pointed out that the markets are pricing in, it seems, an inflation that is starting to peak. So if you do get a CPI number that comes in above estimates, you could see further bruising for these markets. The technology sector is gaining 1.5%. We've seen a move into treasuries. Yields have come off in a fairly pronounced way in the morning, in the session today. The Bloomberg Dollar Index providing some relief as well for some of those cross currencies. Down 0.2, almost 0.3%. Bitcoin remains in focus given the almost 50% drop that we've seen since about November of last year. Currently trading at 30,561. So just hovering above that 30,000 level, down 1.5%. Let's move on and see how things are playing out across the map here then in Europe. We continue, of course, to weigh up the geopolitics and the news that Ukraine has cut off at least part of their gas supplies from Russia. That dispute then pushing gas prices up once again, and then the ripple across to the broader commodity space. You're seeing gains of 0.6% here in the UK. The CAC 40 is one of the outperformers in terms of the major indexes here in Europe, gaining at 0.9%. Over in Germany, the DAX up 0.3%. We've had earnings as well that have come through from the likes of Roche and Continental. So just building out the picture, and of course the focus continuing to be on margins and pricing power that these companies have or do not have. Talking of which, inflation. Ahead of today's inflation print, US Fed governors and presidents have said that they have faith still in their current course of action, even if it leads to a brief recession.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me.
We have a labor market that's so hot, so overstimulated that it's a market where you could pull back a lot of demand for labor, and it would actually be a good thing.
Trying to bring inflation down in that context is going to be hard to do without a brief recession. I'm not forecasting anything like 2008.
50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively.
It's not a situation that calls for an emergency type of move.
Do we need to go above neutral? And that's what I think we're going to learn a lot more about over the next several months.
At this point, I don't care what the reasons are. Inflation's too high, and my job is to get it down.
OK, let's get into these markets then. Joining me now is Bloomberg's markets editor, Eddie van der Walt, and also Ed Smith, CIO at Rathbones. Eddie, let's start with you and how you're assessing the commentary we've heard from some of these officials, particularly Loretta Mester, keeping 75 basis points on the table, wise, arguably, ahead of this CPI print later today.
There's so much riding on this CPI print today. On the one hand, we want to see whether the numbers are starting to come down. But then again, are they coming down too much? The market seems to be calling, for a top, saying that this month will probably be a little bit less hot than last month, coming down to something like 8.1 from 8.5 or 8.3 last month. And, but all of that will just really inform the Fed in terms of how much they can do, because I think really the Fed would like to do more, but they're not sure whether they can, because they realize that they're pulling back on the brakes a little bit. And you're seeing things like the participation rate in the US, which isn't peaking up despite a hot labor market, and the Fed's asking itself, what if we do too much? So there's an awful lot riding on this print today.
Ed Smith, let's bring you in at this point. Is inflation, has it peaked? Are you seeing evidence of that? Do you need to wait for today's CPI to build out that view?
I think, well, one data point doesn't make a trend, and I think unfortunately we're going to have to wait for another 2 or 3 prints before we can really see that catalyst for a market turnaround from peak inflation that many strategists, including ourselves, are predicting. But we think that our base case is that inflation is going to fade back down to target by the second half of 2023. We're seeing consumers prioritize spending on hospitality and travel, cutting back on spending on supply-constrained consumer goods that they spent an outsized amount on over the last 2 years, and that's important for inflation coming back down, coupled with we've got sky-high retail inventories, easing domestic logistical bottlenecks. We should see core goods inflation fall back from 12% in the first quarter to around about 0 by the end of the year. There's risks around services inflation for sure, but we think the fall in goods inflation will offset it.
Eddie van der Velde, let's bring you back in at this point. A little bit of optimism that we've seen in the markets, still not making up for the rout that we saw on Monday. What are you seeing in terms of positioning around CPI and around the reassessment of this rate outlook from the Fed and other central banks?
I think the CPI has been so hard to call. Ed makes a really good point that there's a lot of transitory effects that will start to fade. Really should have started to feed through even now. But it's been really hard to call because inflation has beaten expectations almost month after month. And, that's made it really hard for the markets to position. And what we've actually seen is that something like the dollar, which you would expect to rise on a hot print in previous months, because it just fuels the narrative that the Fed is going to hike quicker. In fact, what we've seen is the dollar has faded in the hour or so after the CPI print comes in. I think we're in for a volatile day, and I think it's going to take a little while for the markets to fully interpret whatever the print is. If it comes in hot, if it comes in cold, I think the market's going to take at least an hour or so to really shake out and work through all the permutations of what that means for Fed policy. So I think we're seeing lower volumes. We're seeing, a very cautious market in the run up to it.
Interesting. Hold on to your hats. The Bloomberg dollar in is currently down 0.2%. A move into Treasuries, yields lower on the US 10-year by 5 basis points, currently at 2.93. Bloomberg's Eddie van der Velde, of course, from MLife, and Ed Smith, co-CI at Rathbone, stays with us. We'll be talking China and other market implications just in the next few minutes. Just to recap some lines, talking about inflation, the central banks, Christine Lagarde, of course, of the ECB, giving some clarity on her views on how things unfold from here, saying that inflation is likely to remain high for some time. It's unlikely, Christine Lagarde says, that disinflationary dynamics of the past will return. And she says it's appropriate for policy to return to normal settings. Euro-dollar, as you can see, currently up 0.2%. Inflation outlook is increasingly on target over the medium term, says Christine Lagarde. She also says inflation expectations currently are at or above 2%. That's pretty clear. But again, inflation outlook over the medium term, she says, increasingly on target. The ECB rate hike, she says, may follow just weeks after the end of bond buys. So this is Christine Lagarde, of course, the head of the ECB, just giving her views, assessment of the inflationary outlook and what that may mean for return to normal policy from Europe's central bank. We'll get more and bring that to you if and when we get more lines crossing from Madame Lagarde. In the meantime, coming up, cases easing in Shanghai, but China's COVID-0 policy comes under criticism from the WHO. We've got more on that next. This is Bloomberg. Economics, finance, politics. This is a Bloomberg Surveillance early edition. We're listening in to the head of the European Central Bank, Christine Lagarde, giving her views on the inflation outlook for the Eurozone. Let's listen in.
Flexibility. The ECB's response, announcing outright monetary transactions, OMT, which was the monetary expression of the now famous whatever it takes, underlined its commitment to its mandate by reacting flexibly to the circumstances. This aimed at ensuring the effective transmission to the euro systems of its monetary policy with a view to maintaining price stability. In parallel, the response from Europe's leaders underscored also their commitment to the euro by launching the banking union plan, including in particular banking supervision and resolution. And this was probably the most significant transfer of authority and powers to the European level since the creation of the euro. And I'm delighted to salute Andrea Enria, who is head of the SSM, who is with us today. But the length and depth of the crisis left deep scars on the euro area economy and set the stage for a long phase of too low inflation to emerge as a result. The double hit of the great financial crisis and the sovereign debt crisis left behind a persistent shortfall in demand and employment. From the onset of the great financial crisis, it took 7 years for the euro area GDP to return to its pre-crisis level and almost 12 years for unemployment to do the same. In Slovenia, those figures were 9 and 11 years respectively. Better. This environment that I have just described dragged down.
OK, Madame Lagarde there, of course, the President of the ECB, just recapping, going back through the recent history of the European Central Bank, previously having said that normalisation, of course, should happen. It's appropriate for policy to return to normal settings. Also on inflation, saying that inflation is likely to remain high for some time, saying that net asset purchases should end in early 3Q or third quarter, and also saying that what we may see in terms of the rate hikes, they may follow weeks, she says, after the end of bond buys. Of course, some debate amongst market participants of whether the rate hike happens in June or July. We'll keep across those lines if anything else crosses for you. Currently, euro-dollar trading higher by 0.3%. And some moves into German bunds, just by 1 basis point lower on the yields there. The Italian BTPs, in terms of the 2-year, lower by 4 basis points. Let's get back to what's happening in China then. Shanghai reporting a 51% drop in new coronavirus infections, with 0 cases found to have spread within the community. For more, we are joined by Bloomberg's Michelle Cortez. Michelle, cases then declining. Does this mean we are finally nearing the end of this outbreak in Shanghai and those very rigid restrictions that have been put in place in China's financial beating heart?
We are absolutely nearing the end of the outbreak in Shanghai. The question is going to be at this point, how much more effort is going to be taken, is going to be needed in order to get back down to the 0 level, which is what China has consistently said that it's going for. Certainly, they want to make sure that they don't have any chains of transmission that are happening anywhere in the country. Now, investors are very excited because there is so much demand, and we want a lot of innovation and production coming out of Shanghai and other parts of China. But if the authorities do want to continue to wring out any last transmission, it could be another couple of weeks or even longer in order to make sure that we are truly back to 0.
OK, Bloomberg's Michelle Cortez, thank you for the update in terms of the COVID situation in China. Ed Smith, co-CIO at Rathbones, still with us, waiting patiently. Ed, when it comes to the question of China, we've had BlackRock removing their bullish call on assets, or at least equities, in China. We had a different view earlier this morning from the likes of Brewin Dolphin and UBS. They think maybe there's some opportunity there. Do we need to start, do investors need to start positioning maybe for a fiscal impulse out of China once and if they get this under control?
Well, we've been negative on China since early 2021, which back then was a pretty contrarian call. We continuously argued against the many strategists that turned more bullish over the last 6 months. And we are still maintaining our negative stance. The threats posed by the zero COVID policy is one. Another reason was we still think there could be an underestimation of the slowdown in property transaction and starts. Residential property transactions in the 7 mega cities have fallen below 2020 COVID levels. We don't want to catch that falling knife. Tight financial conditions. There are some targeted easing measures. More and more of that is being announced, but we don't see it enough to really lift that credit impulse. We don't see the fiscal policy being enough to lift that impulse either. And that's really the key to Asia and Chinese markets outperforming the rest of the world. And look at something like, I just punched in Alibaba's bond yields onto the terminal. It's doubled in the last 6 months, right? Piecemeal stimulus is not enough.
Piecemeal stimulus, and arguably that is what is going to be coming down the pipe, according to many China watchers. Ed, you're more broadly constructive, though, on equities. You're staying invested. You think there's only a 30% chance of recession, but you have switched to more defensive sectors. Where does that take you?
Yeah, that's right. So, I mean, we've got a sort of three-pronged approach to navigating the inflation and stagflation risks. But as you said, our base case is not recession, and corrections only turn into pernicious bear markets when you've got a global recession. But our three-pronged strategy is we want high-quality balance sheets, cash flow statements with high and stable margins, that sort of thing, clear pricing power. We've rotated more away from, we've ditched a lot of cyclicality over the last few months and rotated more into defensive sectors as well. There are some attractive valuations in quality growth names now. We're not shunning growth entirely, but we want to balance that up with value stocks. That's the second prong to our strategy, with earnings or valuations that benefit from higher inflation, higher commodity prices, or higher rates. And then finally, we also want a good chunk of our assets in sort of thematic investments, stocks with structural, acyclical investments to hedge against the risk of a period of stagnant growth. So we like stocks in cloud computing or greening the construction industry, that sort of thing.
OK, a three-pronged strategy in these uncertain times. Just a 30% risk of a recession is the call from Rathbone's Ed Smith. And the top line, just pulling out of your notes, Ed, before we let you go, the start of a tightening cycle is not the time to sell equities. But clearly, as you say, you're moving more defensive and coming out of some of those cyclicals. We always appreciate the insights, Ed. We'll have to get you back on, have more time with you in the next few weeks. Ed Smith, co-CIO at Rathbones, thank you. Coming up, Elon Musk says he'll overturn Twitter's ban on Donald Trump. We'll get the details next. This is Bloomberg. Welcome back. Another story we are watching today is Elon Musk's deal to buy Twitter. He says he would reverse the ban on former President Donald Trump if he takes control.
He has publicly stated that he will not be coming back to Twitter and that he will only be on Truth Social. And this is the point that I'm trying to make, which is perhaps not getting across, is that banning Trump from Twitter didn't end Trump's voice. It will amplify it among the right. And this is why it is morally wrong and flat out stupid.
What's with that picture? You'd have thought a billionaire would be able to have decent kit to get a nice picture. Anyway, we've also had some news on Musk's funding for the deal. Apollo Global is said to be in talks to lead the financing for the buyout. Joining us now for more is Alex Webb from Bloomberg Quick Take. Let's start then with the question about the former US President Donald Trump. It's not a huge surprise. That was the, we assumed, position of Elon Musk before he made it clear that that's what he would do, he'd on board again the former president. What is being read into this? How are people reacting?
I mean, he's sort of tying himself in knots a little bit with the logic. He's saying, well, it's free speech and therefore we should have him on, and actually it's dangerous that he's on this other platform, but then he's not going to come to Twitter, he's going to stay on that other platform now. That assumes you believe Donald Trump when he says he won't come back to Twitter, which is perhaps quite a big assumption. Truth Social, he's barely posted, Donald Trump has barely posted anything on Truth Social. In fact, one of the complaints that the existing users have is that he's barely on there. But there's also an argument that has been made that actually having him in a sort of bubble of his supporters means that he's not dragging people out of the centre and towards his views, which may be, controversial to a lot of people.
And just very briefly, it seems that some investors at least are losing faith that Musk is eventually going to take this company over.
Well, not least because Musk himself has said he's not sure that he's going to be able to take the company over. And he said that as a reason maybe why Donald Trump wouldn't end up back on the platform. The spread is now for $7. 47 is where the share price is, 54 is the offer.
Alex Webb, thank you very much for the latest on Elon Musk's efforts to take over Twitter. That is Alex Webb from Quick Take. Coming up, the UK economy in focus as we put the pandemic largely behind us. Don't miss our interview with NatWest CEO Alison Rose. That is next. This is Bloomberg. Welcome back. Cleveland Fed President Loretta Mester says the FOMC may need to hike by 75 basis points if inflation does not subside. US CPI is out today. Chinese stocks jump as coronavirus cases drop, but a study warns Beijing risks a tsunami of infections if it abandons COVID-0. Plus, European gas supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. The markets, by the way, here in Europe pointing to gains of 0.8%. That's what we've got so far on the European markets. Turned around, slightly more positive than just 30 minutes or so ago. And you've had a move into Treasuries. Yields there are lower. Future stateside pointing to gains of between 0.7 and 0.9%. Now, few leaders in finance have a better read on the state of the UK economy than NatWest CEO Alison Rose. She spoke to Bloomberg for the latest episode of Leaders with Lacqua and offered in-depth perspective on how she sees the post-COVID recovery.
We're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Do you feel more stress than at the beginning of COVID? It's very different. I mean, some customers will be able to pass on, of course, some of this inflation onwards, but then you'll have, a lot of families going through quite a lot.
Yeah, it's very different, and I think it's the experience is very different everywhere. At the moment, we're not seeing signs of stress in what we would see in our data around distress or loans or people asking for requests for help. So it's mainly concerns. But with fuel price rising, for the lower income families, it is quite distressing. At the other end of the scale, you've got a huge amount of liquidity sitting in the economy, on corporate balance sheets, in businesses, from all the quantitative easing that's been done. So you've got a number of things, pulling against each other, which makes it very complex. So I think it's really an important time actually for banks, again, to be really important, because we can provide practical help and support to people.
So what kind of questions do you get?
I mean, it varies. We get a lot of questions from business owners about how they manage disruption to supply chain, how they can fund their working capital, how they can restructure their pricing mechanisms for families. It's how can they save money, in terms of the money they're spending to afford the increase in fuel prices that are coming. And we do something called a financial health check, where invariably we can save people money by bringing their finances together. So it's that proactive conversation.
That was NatWest CEO Alison Rose speaking to Bloomberg's Francine Lacqua, and you can catch that whole interview. That's at 6:30 p.m. London time on Thursday evening, right here on Bloomberg TV. OK, let's get to your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. Philip Morris has agreed to buy smokeless tobacco company Swedish Match in a $16 billion transaction as it pushes beyond cigarettes. The offer from the maker of Marlboro is at a premium of nearly 40% to Match's closing price on Monday. The board of directors at the Stockholm-based company, whose vision statement is a world without cigarettes, said shareholders should accept the offer. Now, Apollo Global Management is said to be in talks to lead a preferred financing for Elon Musk's Twitter buyout. The funding, arranged by Morgan Stanley, will exceed $1 billion and may also include Sixth Street Partners, among other firms. Shares of Twitter did close lower yesterday as traders grow more skeptical that Musk will complete the purchase at the $54.20 offer price. Bloomberg has learned JP Morgan's uninvestable call on China was never meant to see the light of day. Sources say the firm's editorial staff did ask to remove the word from dozens of reports before they were actually published in March, but the label still made it onto 4, including one on JD.com that helped to raise about $200 billion from US and Asian markets. And Coinbase has tumbled and extended trading after revenues missed estimates. The largest US cryptocurrency exchange, which earns a bulk of its sales from trading fees, warned trading volumes in the current quarter will be lower than the first. Coinbase's shares have fallen to record lows, down more than 70% since it did go public a year ago. And that's your Bloomberg Business Flash. Tom.
OK, Leanne, thank you. Now, Cleveland Fed President Loretta Mester said she favours half-point interest rate hikes, but she says she would support bigger increases later. That's if inflation does not ease by the second half of the year. She spoke exclusively with Bloomberg's Mike McKee.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. We're going to have to assess whether inflation is actually moving down, and then we'll be able to get more information after we do a couple of those to see. Both supply and demand are going to be moving over time. So, you know, the aim is we need to use our tools to do what we can to get demand in better alignment with that constrained supply. And so I don't want to rule anything out. When we get to that point in the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, you know, we might be predicting, then we can adjust at that point. But I do think that we need to be very committed to being resolute in doing what we can with our tools to get inflation down. And that's both the balance sheet, which, you know, we've announced that'll start in June, and also with the policy rate.
Well, your colleague John Williams said today he expects unemployment to rise because that's what you do when you raise interest rates. Are you on board with that? Would you warn people, yes, unemployment's going to rise, the economy is going to slow because we need to do that?
Look, we have excess demand in both product markets and in labor markets. So we can raise the interest rate or policy rate and slow that excess demand. But, you know, this is not going to be smooth. There's going to be bumps. And the unemployment rate may have to rise. We may get another quarter of or two of negative growth. But that has to happen in order to get inflation down. So we are tightening financial conditions, and we've got to continue doing that until we see inflation moving back down to our 2% goal.
Well, you get 2 quarters of negative growth, and that's the R word that Fed officials don't like to use.
Yeah. Well, I guess that's a rule of thumb, but it really is going to be like how much is demand slowing? You know, if you look at what happened in the first quarter, there was a negative read on GDP, but if you look at what's happening in the consumer spending side of that report and on the business side of that report, those were quite strong. There's a lot of demand momentum in that report. Yes, government spending went down. Trade, of course, was a big negative for growth in the first quarter. And also that inventory, you know, which had surged in the fourth quarter, there was still a high level of inventory investment, just not as high as in the fourth quarter. So again, I think it's always good to look under the hood of those reports. And we may see some of that happening over time. But again, you know, our goal is to bring inflation under control, have it start moving down towards 2%, and sustain healthy labor markets. I don't really see this as a trade-off right now. You know, in order to make sure that labor markets are sustainably healthy and that we can sustain getting to maximum employment, we need to get inflation under control.
Well, if you get inflation down to where is acceptable, and then what happens? Have we changed inflation dynamics and an inflation regime?
Right. Well, we're aiming for our long-run goal of 2%. Now, if the question is, will it take some time to get down to that level? Yes, because we know that inflation can be persistent, and we have supply constraints that, even though everyone hoped that they would be easing, are not easing, and there's upward risk to inflation. So it will take some time. I don't expect we're going to get inflation down to 2% this year or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy.
OK, Cleveland Fed President Loretta Mester there flagging 2 additional 50 basis point hikes and keeping the table, or at least on the table, the optionality of 75 basis points, at least in the second half. Coming up, gas clash. European supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. We'll get analysis on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, the EU has drafted a $205 billion plan to wean the continent off its dependency on Russian energy. It comes as Russian gas flowing via one of the 2 key main Ukrainian entry points has been halted as occupying forces disrupt operations. For more, we are joined by Bloomberg's senior reporter for international affairs, Mark Champion. Mark, how is Europe going to deal then with Ukraine cutting this gas route?
Right. I mean, this will have an impact. We don't yet know how much gas the Russians will be able to reroute. The Russians say that it's technically impossible for them to reroute it all. We will find out. But for Europe, every time this kind of disruption happens, the price of gas goes up. They have to go source it elsewhere. And we already, of course, had a very elevated price, environment even before the war began. So, what the Europeans are really trying to do now is to sort of cut that loop so that they can, if they can really boost quickly the amount of renewable energy that's being produced, then they don't have to rely so much on further gas and oil supplies in order to replace what they're getting from Russia, so that they can kind of escape that. But there is a difficulty there in that it takes time to develop those new sources of energy, whereas the war is happening right now. It's going to be a sort of a difficult play. And what you can see, it's not quite clear. The Ukrainians say that what happened is that there was a force majeure, that the occupying forces were making it impossible for them to move the gas, but they were fairly vague about that. And the fact is that the Ukrainians do have a motivation, whatever the actual facts of the matter were, but they do have a motivation to cut the gas, to reduce the gas supplies, and basically reduce the revenues that Russia's getting.
Mark, what does this episode tell us about how the war is unfolding in a region I know you have visited?
Well, we're really moving into a war that's going to take some time, a war of attrition. It's grinding and ugly, and likely quite long. So the focus increasingly is on logistics and on supply lines. This is one example. Russia blowing up refineries. Russia blowing up refineries is another, which they've been doing recently in Ukraine. And when I was down just recently in the southern region, which is a very, very quiet region down just south of Odessa, that's become a big transit route now that the ports around Odessa are closed. And the Russians have several times hit the bridge that is really the only direct road link through Ukraine to get out to the EU from there and take all the grain and other cargoes that haven't been able to get out of Odessa.
Okay, severing some of those ties. Mark Champion, thank you. A busy man, clearly, with many phone calls coming through. I hope you get back to those. A man in demand for your expertise. Thank you. We appreciate the time. Now we are joined by Orysia Lutsevych, who is the head of the Ukraine Forum in the Russia and Eurasia Programme at Chatham House. Orysia, thank you for joining us this morning. On some levels, it's very surprising that Russian gas flows continue through Ukraine. But of course, for the parties involved, there is a rationale here. How stark, how salient is the risk now that Russian gas through Ukraine will ultimately be cut off?
Well, I think we have to keep in mind that Russia was always trying to bypass Ukraine, directly rerouting its gas through Nord Stream 1 and Nord Stream 2 that has now been sanctioned. And what Russia wants to show is that Ukraine is not a reliable route for Europe. It's not a reliable partner. At the same time, Ukraine has exactly opposite objective, trying to show that despite the war, Ukraine can actually supply gas, but also grain and cereal that the world is so much dependent on. I think we're in a very dangerous dynamic where energy is used as a weapon. And we did see Russia blackmailing clients in the European Union to pay them in rubles, then cutting off supply to Bulgaria, to Poland. So I think Putin clearly sees energy as the weapon, and this will lead to a major revolution in the European Union, exactly to decouple itself from Russian energy supply.
Yeah, the weaponization of energy, front and focus, front and center for us. And also you touched on commodities, of which, of course, Ukraine plays a major role. What has the ability been of the Ukrainians to continue to ship those commodities from ports like Odessa that have come under attack?
Well, you could call it's another front to ensure that Ukrainian soil is planted with those much needed corn, grains, wheat. And to be honest, it's a battle because there's a lot of risks. Ukrainian agricultural producers and, agricultural workers actually in some places have to wear bulletproof vests to save their lives as they are sowing Ukrainian soil. We have a major problem because of the Black Sea blockade of all the ports. There's a lot of floating mines, and even if the blockade is taking off, it will be very difficult and will take time to restore those routes. But we do know that Romania is trying to restore the old railway connection all the way to Ukraine, that then this Ukrainian grain can go through Romanian ports and further on. That is so much needed in sub-Saharan Africa, China, and other locations.
Indeed. Now, you've talked about the need ultimately for a decisive victory for Ukraine. What would that decisive victory look like, and why is that so central to the future of that country, but also Europe?
Look, Tom, we are having this instability in Europe that led to the major war since 2014, and really since 2008 when Russia invaded Georgia. And what I mean by decisive victory is that this doctrine of Putinism that is telling that Russia should gather its historical lands and restore its empire, call it Soviet Union or whatever, has to be doomed. And that means that Russians should not be allowed to consolidate any new territorial gains in Ukraine, that the ceasefire should include the precondition of Russian troops withdrawing all the way to the line of the 24th of February, that the West actually remains united in making sure that Russia also reforms internally, and sanctions are squeezing out Russian capacity to rearm and to threaten its neighbors. So there's a lot on the plate, but I think that decisive victory means also new Russia that will emerge on the kind of wreckage of that Putin's doctrine I was talking about.
I mean, given what we've heard from some US intelligence and military officials over the last few days about this being a war of attrition and potential escalation from the Russians, that arguably, some would say, seems like wishful thinking, the scenario you've mapped out. And also, of course, your response to the concerns that you could, if you followed that methodology, or at least that outcome, lead to a tipping point where Vladimir Putin reaches in to the nuclear arsenal.
Well, actually, if you follow the recent intelligence report, they're actually telling the opposite, that the risk of Russia using tactical or strategic nuclear weapons is not as high. But I think what we have to also see that Russia is not gaining any tactical gains, and strategically is also losing. Look at the international scene. Finland and Sweden actually is now trying to join NATO, whereas Putin was trying to stop NATO. Russia is not making substantial territorial gains in the Donbass. And United States has signed a major land-lease line for Ukraine on top of the 40 billion assistance. There is a capacity to push Russians out. Otherwise, there would not be all those efforts to allow Ukrainian armed forces to persevere and to defend Ukraine and, for that matter, Europe.
Okay, fascinating insights. Thank you for your time. Orysia Lutsevych, head of the Ukraine Forum in the Russia and Eurasia Programme at Chatham House. Thank you for joining us this morning with your analysis. Coming up, Allianz sets aside an additional $2 billion to resolve lawsuits and probes tied to the collapse of its structured alpha hedge funds. More on that story next. This is Bloomberg. Welcome back. Almost 2 hours into Wednesday's trading session, you're seeing more conviction in the risk-on move that we're seeing across European equities, gaining more than 1%, and certainly moves as well into debt, sovereign debt, particularly BTPs, and yields coming off there, building on the drop in yields that we saw yesterday. About a 14 basis point move yesterday in BTPs. Currently, in terms of the 2-year, you're seeing a move lower in yields by about 8 basis points, and with the 10-year currently at 2.93, a 6 basis point move lower for the Italian BTPs. Euro popping up 0.4%. Christine Lagarde of the ECB just clarifying the outlook in terms of those asset purchases and when rates may start to rise within weeks of that buying starting to end, is what Madame Lagarde said. Let's get to Allianz now, setting aside an additional $2 billion to resolve lawsuits and regulatory probes tied to the collapse of its Florida-based structured alpha hedge fund 2 years ago. That brings its total hit to nearly $6 billion. Joining me now is Bloomberg's finance reporter Tom Metcalf. Tom, so another big set aside in terms of $2 billion for Allianz. The shares are up today, though.
Yeah, it's a bit counterintuitive, but I think it's basically this idea that perhaps this is drawing a line under what's been a pretty horrible scandal for Allianz. So yes, $2 billion hit, but I think the shares are up by more than 2%. And it seems that investors are saying, hey, maybe we're near the end of this.
Just recap for us how we got to this point with Allianz.
Yeah, it's one of the more extraordinary trading moments in the COVID crisis. You know, Allianz, a big kind of typically seen as quite conservative player, suddenly its hedge funds basically imploded. And what the lawsuits are saying is basically they started to lose money and then took bigger and bigger risks to try to make that money back, and it all ended in tears. And since then, they've been being sued by, you know, huge investors, you know, massive US pension funds, saying, hey, you owe us billions of dollars.
Hence setting aside about $6 billion. What does it mean for the reputational risks then of this company, particularly when it comes to those clients in the US?
Yeah, I think that's where, you know, you look at the numbers. Yes, they sort of close this off at $6 billion, but what does this mean for people thinking about investing in Allianz? And, you know, these are very serious accusations. They basically said they sort of skewed the investment mandate. So all to be seen.
Tom Metcalf, thank you for breaking down that Allianz story for us, an update, of course, and how much they're setting aside. In terms of the markets, just recapping, gains of 1.2% here in Europe. You've got upside as well in the future stateside. S&P EMEA is pointing to gains of more than 1%. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz in New York, and Anna Edwards here in London. Stay with us. This is Bloomberg.
The cadence we're going now seems about right to me.
I think the Fed is trying to find an excuse to blink without blinking.
The Fed is very much setting the tone.
The market has finally gotten to the point where it's digested the level and the degree to which the Fed's going to be hawkish.
The markets don't care because they're just all focused on this one thing. The Fed is going to raise interest rates. Inflation is going to run away.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, May 11th. Our top stories today. Investors waiting on today's U.S. inflation report. CPI is expected to show that price growth has slowed to 8%. That's unlikely to be enough, though, to make the Fed change its plans. The struggling stablecoin Terra USD takes a dive. The token plunged from its intended one-to-one peg to the dollar to trade now at about 40 cents. And a different battle between Ukraine and Russia, this one about natural gas. The dispute is now disrupting Russian gas that flows through Ukraine to Europe. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And Kailey, another day of buying stocks, and we're buying bonds as well, it seems, but crucially waiting for that inflation data.
Yep, all eyes will be on that print at 8:30 a.m. Eastern time, so about 3.5 hours to go, Anna. But as you say, it is a positive day for equities really across the world. That was true, too, in Asia, where stocks broadly were higher, a move led by China in particular. Now, on the one hand, you did have some bad news out of China overnight in that both consumer and factory inflation rose at a faster pace than expected, due in part to COVID-related lockdowns. But the actual good news that is boosting sentiment in Asia today is actually related to COVID. Cases on the decline in places like Shanghai, where we saw a 51% drop in cases on Tuesday from the day before. So that's helping lift risk sentiment. They had the CSI 300 up about 1.5% overnight as a result. One stock to point out in Asia, though, that was moving lower was a Japanese stock, Toyota. Of course, the world's biggest automaker gave a weaker than expected forecast, citing an unprecedented rise in costs related to things like logistics and raw materials. So that offsetting some of the benefit of a weaker Japanese yen. That stock ending the day lower by about 4.4%. On the subject of the Japanese yen, though, it is not, in fact, weaker against the dollar today. It's actually one of the outperformers in Asian FX, stronger by about 0.5%. We remain just under that 130 level, so the same range we've been in really for several weeks now. And finally, I would just note you are seeing that bid into the bond market globally. Yields moving lower again today. That was true, too, in Australia, where the 10-year yield came in about 6 basis points to right at 3.5%, Matt.
All right, very cool stuff. I am, of course, continually obsessed with the terror story, and we're going to get to that in just a moment. But right now, take a look at S&P futures gaining 1% and change, so there's a risk-on attitude here. On the other hand, you still see investors buying 10-year debt. You would think normally that they do that if they're hiding from something, but I guess it's an everything rally, a little bit of an everything rally today. 10-year yield down to 2.93%. Crude rallying as well, up 3.25% to 103.03. This is the NYMEX trade, and Bitcoin up just about 0.7%. Not much change from where we saw it here yesterday at 31,214. However, this is very interesting because you would expect the entire crypto world to be in shambles right now, considering what's happening with Terra. It continues to happen with the biggest algorithmic stablecoin. I mean, $18.5 billion in Terra is supposed to stay exactly $18.5 billion. But of course, yesterday we saw it plunge to 60 cents. Today it came down to about 20 cents, currently trading at 46.80. The backer, Do Kwon, has said he's very close to finding a solution, but for something that's supposed to be at $1, this is a shocking failure, a total and complete collapse. And it's interesting to me, Anna, that it hasn't affected Tether. That still holds its peg, and other coins like Bitcoin and Ether are actually rising still today.
Yeah, absolutely. We'll look to see if there is read across into other crypto stories, of course. And Matt keeping an eye on that for us. In terms of the European story, then, European equity markets, as Matt said, seeing a bit of that buying everything sentiment as we wait for the CPI data out of the United States later. So buying stocks, we're up by more than 1% on the CAC 40 and on the Xetra DAX. And we're seeing strength coming through a little bit from the earnings story. But has anything really changed to support this rally after we saw that heavy selling at the end of last week and at the start of this? In terms of the broader picture, then, for equity markets, we're also focused on what's going on with gas prices. So let me talk you through this. We actually saw a jump in European gas prices at the start of trade today, but we've actually come back from that. So we're now down by 1.4%. The reason that those gas prices jumped, because we are seeing disruption now, a stoppage in the supply from Russia to Ukraine through one particular pipeline. But when we saw flows diverted in some instances to another pipeline, that allowed the price to come back down from earlier spikes. So that's what we're seeing on the natural gas front. The euro in focus up by 0.4%. We're watching Christine Lagarde. She's been making a speech earlier on today. She seems to be putting herself in Team July. Is she suggesting that we'll see an interest rate hike just weeks after the ending of the asset purchasing program at the ECB? That seems to be the thinking there. And buyer in focus as the Biden administration urges the Supreme Court to find against Bayer in its appeal on the Roundup weed killer trial. And Roche, also some bad news there, but this on a drug trial around a cancer drug, and that led investors, or analysts rather, to ask whether this had much of a long-term future or as much as had been assumed previously. On to some Russian assets, and the big story around Russian oil here is that Hungary continues to be on a different page from the rest of Europe when it comes to blocking Russian oil imports into the EU. And interestingly, on Russian debt, we're also watching a discussion at the Treasury. Janet Yellen saying that they are, Kailey, discussing whether to continue to allow that exemption, which means that bondholders of Russian debt can continue to receive those payments in connection with those bonds. We'll watch that story.
Absolutely, and we'll be watching a lot of other stories in the day ahead. And of course, we'll get U.S. CPI data at 8:30 a.m. New York time, as we've been discussing. Plus, Atlanta Fed President Raphael Bostic will be speaking at 12 p.m. New York time. And finally, after the bell today, Disney will be reporting its earnings, Matt.
All right, we'll be paying close attention, obviously, to the House of Mouse. Right now, I want to get back, though, to what's going on with this supposed stablecoin, Terra, the algorithmic stablecoin, the biggest one. I think it's the 10th biggest trader by volume on coin market cap. Yesterday, we spoke with Avalabs President John Wu about the purpose of stablecoins.
Stablecoins serve a huge purpose in the crypto and the DeFi economy, and they're here to stay. And I think it'll also help out, all activity on various chains. So I hope the regulators recognize that as well.
John also pointed out the difference between an algorithmic stablecoin and an asset-backed stablecoin like Tether, which is holding its peg. But let's talk to Eddie Vanderwald about what's going on here. Shockingly, the founder, Do Kwon, he keeps tweeting, "Steady, lads, hang tight, stay strong, lunatics. I'm going to come up with a solution." But you want your dollar to be worth $1, don't you?
Right. You want a stable coin to be stable. It's kind of in the name, right? But clearly, when you trust the math and when you trust the correlations, which is what they've done here, sometimes those correlations change. We've seen this in wider markets, right? Correlations across asset prices, when on the way down particularly, they tend towards 1. So when you use a basket of assets to, approximate what you think the dollar is going to do, and then you see the cryptocurrency space draw down. If you then use a lot of crypto, you're gonna see those things tend towards 1. You're gonna see the space as a whole going down at the same time. We've seen this time and time again in cryptocurrencies, and that's why most of the big, the Tethers, the USD coins, that's why they have most of their assets in highly liquid, outside of the cryptocurrency space assets. That's why they're staying stable right now with assets of, a total of, I think just for those two, $130 billion.
Well, and Eddie, of course, as you talk about a drawdown in cryptocurrencies, Coinbase, the crypto exchange, also out with earnings yesterday, warning of a drawdown in volume, saying it's going to be even worse in the current period than the last. And the CEO also talking about the black swan risk of a bankruptcy. What is your reaction to all of that?
I think this is the crypto space growing up a little bit. You are seeing that as they have a wider investor base, as they are trading on public exchanges, they are finding that they have to update their investors, right? And I think that's what we're seeing here. They are being cautious. They are saying, listen, we're aware of the volatility that we're seeing across the space, and I actually think this is a good thing, just updating your investors. It's not like previous times in the crypto. Yes.
Eddie, the big problem here, I think, is if they do go bankrupt, they point out, if you're holding your crypto on their exchange, you could lose it all. And this is a massive problem for one of the central tenets of blockchain-based currencies. You should have ultimate ownership. But if you've let them stay on Coinbase, they could be wiped out.
Oh, absolutely. It is a problem. But at least we're not in a situation where we were 2, 3, 4 years ago, where exchanges just went bust. There was zero warning. Now, are we going to see a bit of a run on those assets inside of Coinbase? I think time will tell. I mean, it is a big red flag for the people who've left their all of their crypto there. But I mean, those in the crypto space who've been there long enough will tell you, look, all of your money that you want to keep in stable, keep it in off-exchange wallets.
Eddie, thanks very much. Bloomberg's Eddie van der Welt with the latest there on crypto. Broader markets now. U.S. inflation is in the spotlight today with April CPI growth set to slow. Bloomberg's Michael McKee spoke to Cleveland Fed President Loretta Mester exclusively.
It will take some time. I don't expect we're going to get inflation down to 2% this year or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy.
Let's get more from Bloomberg's Laura Wright on the inflation front. And Laura, we had Chinese inflation overnight. We now focus on US inflation.
The market on a knife edge awaiting US CPI data. I spoke with one strategist yesterday who told me, look, Laura, right now we're all armchair economists in this environment. The projection is for 8.1% the month of April, year over year. If that materializes, it would be a slight moderation from the previous month's reading of 8.5%. And that would be driven by declining goods prices, offsetting increased prices in services. Now, if we do see a strong beat on CPI, there will be pain for risks assets, likely an outsized reaction in nominal yields. But that said, traders appear to have priced in that we have seen peak inflation, and that is illustrated by 5-year break-evens, which have fallen below 3% yesterday for the first time since February the 23rd, with a 30 basis point downward move in the last 2 sessions alone. Now, for China, it was a beat on both CPI and PPI, with CPI landing just over 2%, PPI at 8%. For consumers, that was higher food costs, higher fuel costs. Producers, it's a story of supply chain congestion, elevated commodity prices, rolling lockdowns in China. But these upside beats beg the question, can policymakers in Beijing inject more stimulus? And that means, will Beijing, after all, be able to achieve its growth target of 5.5%?
Yeah, absolutely. And what kind of stimulus? What's going to look like? Laura, thanks very much for that report on inflation, global inflation. Let's get to Ukraine. Russia has clashed with Ukraine over natural gas sent to pipelines that are intended to end up in Europe. It's a dispute that is disrupting supplies again, leaving Ukraine for the first time since the invasion in a pretty vulnerable position energy-wise. Ukraine says the Russian gas flowing from one of 2 key entry points will stop today. Anna Shurevskaya, Bloomberg natural gas reporter, joins us now for more. So, Anna, first of all, it's pretty amazing that the gas has continued to flow through despite the war over the last month and change. But now I guess that's over.
Well, it's not over completely. Gas is still flowing via the second of the 2 key entry points for Russian gas into Ukraine, for transit into Europe. The flows halted at one of the stations because Ukrainian grid operators said that they cannot accept gas because the infrastructure is now controlled by the occupying forces, so they can no longer control the operations themselves. Still, nonetheless, flows into the second station somewhat increased since yesterday. So overall, we are talking about an 18% decline in Russian gas flows via Ukraine to Europe today versus yesterday. So it's not complete halt yet, but nonetheless, risks remain because obviously the 2 countries may now engage into rhetorics and blame each other, and it's still a story that's developing.
All right, Bloomberg's Anna Shurevskaya, thank you so much. Now let's head over to Washington, where the U.S. House has approved a $40 billion emergency spending aid bill for Ukraine. That measure pays for new weapons and provides economic and humanitarian assistance. Anne-Marie Horton, Bloomberg Washington correspondent, joins us now from D.C. Anne-Marie, should we expect this also to sail through the Senate?
Yeah, it is likely to sail through. I mean, the bipartisanship on this bill is huge. You had a 368 to 57 votes. You can see there on both sides of the aisle, there's a lot of support for sending more money and Ukrainian aid over. This also comes after Senate Republicans actually spent lunch sitting down with the Ukrainian ambassador to the United States, Oksana Markarova, and left that lunch saying they do feel like Ukraine was using these funds in the appropriate manner. But we should note, this is a huge package. The president asked for $33 billion. This is $7 billion more. A lot of that is going towards defense and humanitarian aid. $20 billion really for the defense part of that. And we should note that $9 billion that will be used in the Pentagon to restock the U.S.'s stocks because they sent so much over. You also have funds going to things like global food and humanitarian security, as well as money to repair the U.S. embassy in Ukraine. But Kailey, as you say, just right now it's in the House. Next week, likely it'll sail through the Senate.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Hordern in Washington with an update on aid from the US to Ukraine. Coming up, we'll get back to the markets conversation. Ben Gutteridge, Director of Model Portfolio Services and Invesco EMEA, joins us. What is he expecting from the inflation picture out of the US? How game-changing will this number be or otherwise? And the hardest hit US town is having to put up with 10% inflation and $6 milk. Apparently that's a lot. Read more about it in today's Big Take story. Just type NI Big Take into your terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and on Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now, we're focused pretty firmly on inflation today. We're going to get the CPI numbers out a little bit later. I have a chart here that shows U.S. break-evens, and 10-year and 5-year break-evens are both now below 3%. 2-year break-evens coming down under 4 right now at about 3.75. So inflation expectations are abating, and the question is, what does that mean for markets? Do we move on to growth fears rather than inflation fears? Let's bring in Ven Ram to talk about this. He's a Bloomberg cross-asset strategist. He writes for the MLive blog. Ven, what do you think about today's print? And if we do see that inflation has peaked, what's that going to mean for markets going forward?
Morning, Matt. If we do see that inflation has peaked from today's print, what we will see is a continued rally in rates. Why do I say that? Because we were pricing in 200 basis points of steepening from the Fed in the next 5 meetings. Now we have come off those levels now. We are pricing in about 185 basis points. Now, if we get evidence further today that inflation is, as predicted, cooling, then that pricing will loosen some more. And therefore, I think that we have seen the peak on the front-end yields, specifically the 2-year yield. And I think that we will move back to around 252 levels on the front end.
Okay, so 2.57 is where we trade. We'll remember that number as we go into the print then, Ven. Let me ask you about FX markets, because dollar strength had been such a theme in recent weeks, and that seems to have stalled just in the last couple of days with greater risk appetite. If we go into the second half of the year, though, worrying more about growth, where does that leave strong dollar and other FX?
I think that I just wrote yesterday on the terminal that we are approaching peak territory on dollar strength, and that was predicated on the steepening and on the tightening factored in by the markets for the Fed. Now, if we are going to come off on that Fed pricing, I think that is going to remove that much of dollar support. And I therefore think that the dollar may weaken from these elevated, very elevated levels that we have seen of late. Specifically, that means that the dollar index will come off those 103, 104 handles back down to more moderate levels of 100 or so on the index.
Ven, thanks so much for your time. Ven Ram of the Bloomberg Markets Live team, thank you for joining us. Remember, you can get some market analysis, the up-to-date take from the Markets Live team on their blog. MLIV Go is the function to use on the terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Researchers in Shanghai says China faces a tsunami of coronavirus infections if the government abandons its long-held COVID-0 policy. They warn that could lead to 1.6 million deaths. The study says that China's vaccination campaign would be insufficient to prevent an Omicron wave that would swamp hospitals. President Biden wants to do something about rising food prices. He's proposing measures to reduce costs for farmers, such as doubling investment in fertilizer production and extending government programs that use technology to reduce the use of fertilizer, and so-called double cropping insurance that gives farmers coverage if they plant more than one crop will be extended. Economist Lisa Cook will be the first black woman on the Federal Reserve Board of Governors. She won Senate confirmation by the narrowest possible margin. The 51-50 vote required a tie-breaking appearance by Vice President Kamala Harris. Republicans, of course, had questioned Cook's qualifications, Anna.
Coming up on the program, Ben Gutteridge, Director of Model Portfolio Services at Invesco EMEA. We will work our way up to that inflation print later on today. What's at stake for bond markets and then hence other assets? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors waiting for today's U.S. inflation report. CPI is expected to show that price growth has slowed to 8%. That's unlikely to be enough of a fall to make the Fed change its plans. The struggling stablecoin Terra USD has taken a dive. The token plunged from its intended one-to-one peg to the dollar to trade at about 40 cents on the dollar. Crypto markets are waiting for a rescue by Terra USD's primary backer. And a different battle between Ukraine and Russia, this one about natural gas. The dispute is disrupting supplies of Russian gas that flow through Ukraine to Europe. Ukraine blames the disruption on Russian forces. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, we do see quite a lot of risk appetite then, European stocks moving higher, bonds being bought as well. But we're really waiting for the next take on U.S. inflation, I suppose, to work out where we go next.
True. I mean, CPI is where we're focused today. But it's interesting that we're seeing still so much risk on appetite here, even though we have the collapse of Terra and the warning from Coinbase, et cetera. So it doesn't look like there's a lot bleeding over from one portion of the crypto universe into the rest of the crypto universe, or indeed the rest of the markets. Plain vanilla S&P futures up more than 1% right now. U.S. 10-year yield coming down right now, 293, but that does mean investors are buying bonds, so maybe hedging their bets. Crude up 3% at 102.75. That's for Texas Intermediate. And Bitcoin right now at 31,376. So it dipped below 30,000 a couple of days ago, instantly shot back up, and now we've been hovering at this level for about 24 hours. Check out Terra. You mentioned Do Kwon, the backer of these lunatics, as they're known, because Terra is connected to the cryptocurrency Luna, and they have both collapsed. Terra, of course, is supposed to stay at $1. It's a stable coin, or it was a stable coin, an algorithmic stable coin, different from an asset-backed stable coin. Right now, it's worth about half that, 49 cents. And we're waiting on some kind of solution. But as I've said, Kailey, it's fascinating that this failure hasn't bled through. There hasn't been contagion in the rest of the market.
Yep, no contagion into those asset-backed stablecoins like Tether, no contagion really into Bitcoin. It's interesting, though, to see how this may affect sentiment, especially on the part of the retail trader. And that's where I want to point out Coinbase, which, of course, reported earnings after the bell yesterday, missed on expectations in the first quarter. Plus, it said that volume in this current period in the second quarter is going to be even lower than the first quarter. So clearly a not great signal about sentiment in the crypto markets at the moment. And then, of course, you had the CEO, Brian Armstrong, out on Twitter yesterday talking about their updated disclosures about how they hold crypto assets at Coinbase, and in the risk of a black swan event like a bankruptcy, everybody who has all of their assets at Coinbase could be at risk of losing them. So that's something to consider. That stock is down about 20% at this point, but it's an even bigger decline in early hours for Unity Software. This is a gaming developer. It gave a disappointing revenue forecast. It's down nearly 28%, while Rocket, of course, the mortgage company, also disappointed. It's down about 9%. Finally, Anna, I just wanted to point out Twitter because we have had some news around Elon Musk in the last 24 hours. First, Bloomberg reporting overnight that Apollo wants to lead a $1 billion financing package for Musk's takeover. But then Elon Musk himself yesterday was talking about, how he might give President Donald Trump, the former president, access to Twitter once again, reverse that ban if he does indeed come to own the company. But he did say that's an if. It's not guaranteed yet. And clearly investors also still have some questions about whether or not he's actually going to succeed. Yes, Matt.
And the former president has said he's not coming back to Twitter anyway.
Right,
so.
Because Truth Social is out there. So that's something to consider. Point of story, though, investors clearly still have doubts about that because Elon Musk said he'd pay $54.20. Right now, that stock trading at $47.58, Anna.
Yeah, so the gap between those, the execution risk then on that deal. Let's have a look at where the European markets are. Only a couple of sectors in negative territory, actually. So it's quite broad-based, this rally we're seeing in European stocks today after the losses that we saw at the end of last week and the beginning of this. Stocks Europe 600 up by 1.2%. We're selling out of healthcare, buying consumer products. The euro in focus up by 0.3%, 105 handle there. Christine Lagarde seems to be in camp July, Team July, when it comes to putting a date on when we get that first hike from the ECB. She suggested there could just be weeks between the end of asset purchasing and the first rate hike. Bayer is in focus because the Biden administration is suggesting to the Supreme Court that they should find against Bayer in its appeal on that Roundup trial. And Roche moving lower this morning, down by 5.5%. This after the company revealed the results of one of their trials of a cancer drug that's got some analysts asking whether it really has such a future as had previously been anticipated. On to some Russian assets for you, and big questions still about the EU's intended embargo on Russian oil, because Hungary's still on a different page on that front. We're also keeping an eye on the Russian bond markets, because the Treasury says that Treasury in the US, this is Janet Yellen saying that they are doing some analysis on whether to extend that exemption that bondholders have for receiving those payments from Russia. We'll keep an eye on that story then, Kailey.
Absolutely, Anna. Of course, we're also monitoring the Fed speak we have continued to get throughout this week, including from Cleveland Fed President Loretta Mester, who yesterday said she's backing up half-point rate hikes, but she would support bigger increments later if inflation does not ease. She spoke exclusively with Bloomberg's Michael McKee. Take a listen.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. In the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, we might be predicting, then we can adjust at that point.
Ben Gutteridge, Director of Model Portfolio Services at Invesco EMEA, is joining us now. Ben, even if we see the peak of inflation today, or it proved out that we've already seen the peak of inflation, does that mean we've seen peak pain in the equity markets?
Well, I mean, it will of course depend on the path for inflation and how policy evolves thereafter. I think, if inflation does, today does mark the start of a trend reversing inflation and it moving lower, then of course that will bring much relief to consumers and of course allow policymakers to tighten at a more cautious pace. So on that basis, yes, I think that would mark the end of the acute pain that we've seen in equity markets. But it could be a volatile period in the short term, of course, because there are still many growth challenges ahead.
OK, Ben, good morning. What do we make of the fact we've seen break-evens dropping back in the US? So if you look out 5 years, 10 years, you get a sense that inflation expectations are coming down from these previously really elevated levels. That tells us maybe that the market's coming round to the Fed can do something about this. Does that mean stocks can... Is that a situation that allows stocks to rally?
Yes, I think so. I mean, you're right. I would take it that the market has seen the intent in the Federal Reserve's eyes, if you like, that they really mean business on tackling inflation, and therefore longer-term inflation expectations have moved lower. And that can be supportive for equity markets. But, we are seeing a lot of attention on sort of short-term data. And, of course, I think, there would need some sort of corroboration, if you like, from CPI and CPI trends really to get... sentiment moving in a more positive direction. But the platform is there from falling inflation expectations. OK, so for falling inflation expectations, stocks can rally. But which stocks then, Ben? Are you still looking for inflation fighters? Because even if you come down from 8.4% to 8% or so on inflation, that's still really high and still a long way to go. The path down to 3% still will take some time to navigate, I assume. Yes, sure. And I don't know if I've been ushered into this sort of angle of stock conversation, but it's not necessarily my view that inflation is going to fall, dramatically, and that therefore the consumer is still going to be under pressure. We don't think a recession is the likely outcome, but we think equities can perform. But in an environment where you've got slowing growth, inflation a bit sticky but falling, you want to have more defensive sort of sectors in there. That could be healthcare or consumer staples.
Even in Europe, Ben, you don't see a recession on the continent either?
Well picked up. Good point. No, I think in the US, it's less likely that we see a recession. In Europe, we're really flirting with it, aren't we? I mean, the data, the soft data and the hard data has a real sort of recessionary flavour to it. And so, you know, we could well be on the cusp or in the midst of a recession in Europe. But of course, Europe has moved much more quickly to price in those negative growth expectations.
Ben, what is Model Portfolio Services? You're the director of Model Portfolio Services at Invesco. So what is that?
It's a place to hide. It's a place to be a coward. No, we need to build diversified portfolios and really not swing for it. But that doesn't mean we don't impart our views onto portfolios. We're just trying to build things that are portfolios that are balanced. But as I said, our views we still have the room to impress our views, which would be a preference for equities, but probably more defensive type equities, US markets and those more defensive sectors, given we're in the midst of a growth slowdown. But we still recognise the appeal of value assets and more inflation fighters that Anna was referring to.
Does it make sense to you then? I mean, the last couple of days we've seen, and I know you have certainly much longer term time horizons, but we've seen rallies in equities, recovery in equities, and investors buying bonds at the same time. Does that make sense to you right now?
Well, the short-term gyrations of investors can often be confusing, but you know, the way we see investor behaviour at the moment is that there is a tremendous amount of nervousness, as revealed by sort of surveys, but it hasn't revealed itself in mass selling. I think there is still this sort of TINA element. There's very little alternative to equities out there. And so whilst they're nervous about holding equities, they haven't feel compelled to sell them. And of course, that makes us a little bit nervous in the short term, is that if we do get sort of disappointments on data, that there could still be yet more selling to come. But bond markets are starting to look more interesting as a diversifier because those yields have picked up. So, you know, short-term activity is hard to call, but there is certainly some nervousness that equities could be under more selling pressure and that bonds could be bought from here.
Ben, thanks very much. Ben Gutteridge, Director of Model Portfolio Services at Invesco EMEA. Thank you very much for your time. Coming up on the programme, the US inflation report is due out in just a few hours. We've been talking a bit about it already. We'll get some further analysis and discuss what to expect. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, former Council of Economic Advisors Chairman Jason Furman. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
Our economy has gone from being on the mend to on the move. But for every worker I met who's gained a little bit of breathing room to seek out a better paying job, for every entrepreneur who's gained the confidence to pursue their small business dreams, I know that families all across America are hurting because of inflation.
President Biden there speaking about inflation at the White House yesterday. Investors will get fresh US CPI data at 8:30 a.m. Wall Street time. For more on the global inflation story, we're joined now by Simon Kennedy, Bloomberg Executive Editor for Economics. And Simon, this is clearly a global problem. Every politician talking about it, trying to think of ways to address it, it seems. But it is a global phenomenon. In the US, we are perhaps coming to a point where we've reached peak inflation then. That seems to be what economists are expecting to see today.
Yeah, so we saw in March it was 8.5%. In April, they're looking at 8.1%. You know, an insane level if you'd thought about it 2 years ago, but at least it's so some signs of a peak there, although the concern actually is that we're going to plateau at above 8%. The core rate may pick up as well, which will throw into question that peak debate. And so it's definitely a tricky moment for the Fed, a tricky moment for the Biden administration, just where prices will go. In theory, the leveling off of energy should have cooled somewhat.
Hang on, Simon. So Anna said, you know, globally, leaders are all trying to think of ways to address the inflation problem. Is that true? I thought the idea was that in the UK, Boris Johnson
talking about it anyway.
Johnson doesn't have any ideas or any ways to address inflation for the people of the UK, right?
They're certainly talking about it, and there's various initiatives that they could produce. But certainly, yes, in the Queen's speech yesterday, light on details about that cost of living crisis. The onus still on the central banks to be the ones to lead this charge against the price pressures. But there are signs elsewhere of governments taking steps and trying to do what they can. But as as has long been said, inflation is a monetary phenomenon, and that leaves it in the hands of the central banks, who are perhaps a bit too late to the party when it comes to tightening monetary policy.
That's interesting, because I'm interested in your take on what the market is now assuming will happen to inflation. If we look at break-evens, we've mentioned this a few times on the programme, break-evens, those inflation expectations in the market have been coming down, as if investors have concluded, oh, look, the Fed's actually going to be doing something serious about this and having some success. I mean, if you're looking for inflation to moderate, that's a really crucial data point to take on board.
Unless they're betting that the Fed will fail and that it'll be driving the economy into recession to beat the inflation, in which case you bring the inflation expectations down. For the moment, and there obviously has been a debate in academic circles and among economists about whether the Fed has got it right or wrong. The signs are that still credibility is with there's trust in the central banks to get it right. It'll just probably have to move. The Fed, for example, is going to move much faster than it was thinking it would have to earlier in the year. And Jerome Powell last week, talking over the heads of reporters and economists on Wall Street to the American people to try to explain that it's going to be cracking down on inflation.
Yeah, well, Simon, when Jerome Powell spoke last week, he also spoke of the risks stemming not just from the war in Ukraine, but also China and COVID-related lockdowns there. What signals should we take from the data out of China overnight that saw both consumer and factory prices up more than expected in April?
So certainly the prices are going up in China. There is some argument made today by Bloomberg Economics on the terminal that actually those COVID lockdowns will eventually add a disinflationary force to the world economy. One of the things that Jerome Powell and others, including Neil Kashkari, have pointed out is there's a lot affecting US inflation at the moment that is beyond their control. They can't drill for oil. They can't clear up COVID in China. They can't deliver better supply chains. So those supply issues, as long as those remain, those global factors, supply challenges, as long as those remain out there, as long as those continue to drive up inflation, the question for the Fed is, does it want to, how much does it need to crush the demand side of the economy to bring supply and demand back into balance? If it wants to do that or needs to do that, it's going to have to push interest rates up. Perhaps much higher than what markets are thinking. Again, back to the data this morning from China, some signs of easing, but ultimately, again, topping forecasts there.
Simon, what more can the Biden administration do, let alone just the Fed?
So the Biden administration is looking at a whole series of ideas. One that's proved popular in recent weeks and hasn't been ruled out completely is the idea that you knock some of the tariffs that on China that were imposed during the trade war. Obviously, that's a geopolitical strategic question as much as a economic question. There does seem to be some divide within the administration over whether that's the right approach. But people such as Larry Summers, the Peterson Institute, have all proposed that dealing with the tariffs, taking some of those tariffs off, would provide some easing for the economy's inflation problems.
OK, Simon, thanks very much. Bloomberg's Simon Kennedy with the latest on the US inflation story. Of course, we heard from Laura about the Chinese story earlier on in the programme. Inflation in food prices clearly matters a great deal in lots of parts of the world, certainly in many parts of the emerging markets. And Sri Lanka has been seeing some violence due to that and other factors. We're hearing from the central bank chief in Sri Lanka saying that he will quit if there is no stability in Sri Lanka. These comments coming through from the central bank chief. Earlier, we heard from the central bank that it was setting a daily trading ban for its currency against the US dollar, trying to stem the volatility there. And for more on the inflation story, check out today's Big Take story about the Texas town that is having to put up with 10% inflation and $6 milk. Just type NI Big Take into your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. We are joined now as well by Tom Keene, co-anchor and creator of Bloomberg Surveillance. And you've got a single... By the way, have you made an NFT of your bow tie yet?
No, it's under discussion. The entourage is looking at it. We're really worried about it when you look at, if I'm going to do it, it's going to be called stable bow tie is where we're heading.
What's your single best chart today, Tom?
My single best chart is not on a train wreck in BitDog and the rest of them. We'll go cover that. Look for that on radio this morning, 10 a.m., 60 minutes straight of Matt Miller on BitDog. That'll be painful. Also painful is the inflation we're all living right now. This is a really, really, really important chart because worldwide you're living it. The little blue line is the guesstimate today, 8.1%. And what's important is the bottom line is the spectacular surge in goods inflation, think 11%. In service sectors, even elevated a little bit as well, from 3-ish out to 4-ish. The dispersion is tangible. Goods inflation is the bet. It's got to come in. We'll see.
Okay, I wonder what Bill Dudley, former New York Fed president, thinks we're going to see on the inflation story. I also wonder what he thinks about stablecoin, but mostly inflation.
Well, it's on inflation, Anna, and he just published. We'll have Mr. Dudley with us this morning. Dr. Dudley doesn't mince any words. He says this is a Fed that is way too coy. They've got to identify their plan forward, and what's critical is Dr. Dudley makes clear the goal of getting back to 4% is not acceptable. That's going to be the debate for later this summer.
Yep. What kind of inflation is the Fed going to be comfortable seeing at the end of this year? Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much for joining us. And like Tom, of course, I am going to be watching the CPI data today. We're just over 2.5 hours from getting that print. But what I'm really interested in is the market reaction to it, given we are seeing a continued rebound in equities today. And we have seen a dramatic pullback in inflation expectations as measured by break-even rates. The 5-year break-even coming in 31 basis points in the last 3 days. So if we do see an 8.1% handle number on inflation, does the market just say that reinforces our thinking that the peak is past us, everything's okay, continue on? Or would a hotter than expected print throw everything we've seen in the last couple days into chaos, Matt? It'll be really interesting to see.
Yeah, I cannot wait to see that CPI print. It's 8:30, right? So just about 2.5 hours from now, 1:30 UK time. I'm watching Terra USD, though, the stablecoin, formerly stablecoin, algorithmic-based, not asset-based, so it's different than Tether, for example, which has held its dollar peg. You can see here Terra trading at 48 cents, so less than half of where it should be right now. The backer Do Kwon, or as he's known on Twitter, Stablecoin, has announced that he's close to announcing a recovery plan for UST. He says hang tight. He refers to his supporters as lads. He says getting close. He says stay strong, lunatics. I guess Diamond Hands isn't far off from what his next tweet could be, but it'll be interesting to watch what kind of solution he comes up with, because as Tom points out, you know, there's been a collapse in the price of BitDog from $69,000 just 6 months ago to under 30 a couple days ago.
I'm sure lunatics is a compliment, although it might not always seem as such. I'll be watching the House of Mouse, as you referred to it earlier, Matt. Disney earnings out later, the secret weapon perhaps as the real world fights back against the stay-at-home economy. They're parked, but we'll, of course, crucially be watching subscriber numbers. Inflation is up shortly. Surveillance is next. This is Bloomberg.